Bitcoin just dropped below 66,000. Ethereum is struggling. Altcoins are bleeding. Crypto liquidations just surged to nearly 1.8 billion in 24 hours. Retail sentiment across X and Reddit has turned overwhelmingly bearish. And yet, while fear dominates headlines, institutions, banks, payment giants, and lawmakers are quietly doing something different. They're building. In today's episode, we're connecting the dots between market panic, regulatory progress, stablecoin expansion, banking adoption, and why some of the biggest financial players in the world appear to be preparing for a future that most investors still can't see. Let's get into it. Nothing in this video is financial advice. Always do your own research before making any investment decisions. Welcome back to Ledger Pulse, where we track the intersection of crypto, blockchain, finance, and the future of global markets. If you enjoy these deep dives, make sure to subscribe and turn on notifications so you never miss an update. Now let's break down what just happened. The market has been hit hard. Bitcoin fell below 66,000 for the first time since early April. Ethereum remains under pressure, and many altcoins have retraced significantly from recent highs. At the same time, crypto liquidations exploded to roughly 1.8 billion in a single day, one of the largest wipeouts we've seen in recent months. When leverage gets flushed out at this scale, emotions usually take over, and that's exactly what we're seeing right now. One of the more interesting indicators comes from social sentiment data. Both Reddit and X are showing unusually bearish readings, with discussions overwhelmingly focused on lower prices and continued downside. Historically, periods of extreme fear often appear near major market turning points. That doesn't mean a bottom is guaranteed, but it does mean the crowd is becoming increasingly one-sided, and markets rarely reward consensus for very long. While price action grabs attention, Washington may be quietly producing one of the most important developments of the year. The Clarity Act has now been added to the U.S. Senate legislative calendar. That doesn't mean passage is imminent. However, it represents another meaningful step in the legislative process. Industry advocates continue pushing for clearer digital asset regulations, arguing that uncertainty has driven innovation overseas. What's particularly notable is the growing coalition supporting this effort. A recent letter signed by more than 160 former national security, intelligence, and law enforcement officials urged Senate leaders to advance the legislation. Their argument wasn't centered on speculation. It was centered on national competitiveness, enforcement efficiency, anti-money laundering standards, and maintaining U.S. leadership in financial innovation. For years, crypto regulation has been defined by uncertainty. The Clarity Act represents an attempt to replace uncertainty with rules, and markets have historically rewarded clarity, not confusion. While many investors remain focused on token prices, the biggest story in crypto may actually be stablecoins. This week, Mastercard expanded settlement support for regulated stablecoins, including USDC, RLUSD, and PYUSD. The expansion now reaches multiple major blockchain ecosystems, including Ethereum, Solana, Base, Arbitrum, and XRPL. Think about what that means. One of the world's largest payment networks is continuing to integrate blockchain-based dollars into its infrastructure. This isn't experimentation anymore. This is implementation. The financial system is gradually building the rails necessary for digital asset settlement at scale, and stablecoins are increasingly becoming the bridge between traditional finance and blockchain networks. Another major development comes from Franklin Templeton and MoonPay. The partnership enables institutional investors to move stablecoins into tokenized money market funds around the clock, 24 hours a day, 7 days a week, without leaving blockchain networks. This is important because traditional financial markets still operate on legacy schedules. Tokenized assets don't. Capital can move instantly. Settlement can occur continuously. Liquidity can become significantly more efficient. The long-term implication is simple. Financial products that currently exist inside traditional systems are increasingly being recreated on blockchain infrastructure, and institutions appear to be accelerating that transition. One development that may have flown under the radar involves Société Générale-FORGE. The banking subsidiary has expanded its stablecoin strategy to include XRPL alongside Ethereum, Solana, and Stellar. This matters for a few reasons. First, it represents another major financial institution choosing to operate across multiple blockchain ecosystems. Second, it places XRPL alongside some of the most established networks in the industry. And third, It reinforces a broader trend we've been discussing for months. Banks aren't debating whether blockchain technology has a future. They're deciding which networks will help power that future. That distinction is critical because adoption doesn't happen through headlines. It happens through infrastructure. Another sign of accelerating adoption came from MoneyGram. The company announced MGUSD, a US dollar stablecoin built on Stellar. This continues a pattern we've seen repeatedly over the last several years. Companies that facilitate global payments increasingly recognize the advantages of blockchain-based settlement. Faster transactions, lower cost, greater accessibility, improved efficiency. Whether it's Stellar, XRPL, Ethereum, Solana, or other networks, the broader trend remains the same. Real-world financial infrastructure continues moving on-chain. One of the most interesting announcements came from Charles Schwab. The firm is reportedly targeting mid-2027 to launch spot crypto trading and custody capabilities for financial advisors. This may seem far away, but consider the scale. Charles Schwab oversees trillions of dollars in client assets. When large financial institutions build crypto infrastructure, they're not doing it for today's market. They're preparing for the next decade. The significance isn't the exact launch date. The significance is that another major financial institution sees enough long-term demand to justify building the infrastructure now. That's a recurring theme throughout this entire episode. Now step back and look at everything together. Markets are fearful, liquidations are surging, sentiment is bearish, prices under pressure. But simultaneously, regulatory frameworks continue advancing, stablecoin adoption continues expanding, global banks continue building, institutional products continue moving on-chain, payment networks continue integrating blockchain infrastructure, major financial firms continue preparing crypto offerings. In other words, price and infrastructure are currently telling two very different stories. The market is focused on today's volatility. Institutions appear focused on tomorrow's financial system. And historically, infrastructure tends to outlast sentiment. The coming weeks will likely remain volatile. Markets rarely move in straight lines. But one thing is becoming increasingly difficult to ignore. While fear dominates the conversation, adoption continues advancing. The rails are being built. The regulations are slowly taking shape. The institutions are positioning themselves. And the technology continues moving forward regardless of short-term market fluctuations. The question isn't whether blockchain is being integrated into finance. The evidence increasingly suggests that it already is. The real question is how large that transformation ultimately becomes. And that's what I'll be watching here on Ledger Pulse. If you enjoyed this episode, hit the like button, subscribe, and share your thoughts in the comments below. Are we witnessing a temporary market correction, or the final stages of infrastructure being built before the next major phase of adoption? Thanks for listening, and we'll catch you in the next one.